Hello, and welcome to the Climate Change and Financial Reporting webcast. I'm Scott Bandura, a partner in PwC's Global Accounting Consulting Services team, and I'm joined by my fellow partner from the global team, Gary Berchowitz. In the previous Q4 Global Accounting webcast released in December 2020, we looked at the ISB's educational materials on climate change and shared a high-level overview of the way climate change can impact financial reporting. This webcast will take you on a bit of a deeper dive into the financial reporting impacts of climate risk and what you should be thinking about now in your accounting. This webcast will primarily focus on financial reporting implications of climate change, how climate risk impacts the numbers and disclosures in the financial statements, but of course, climate change and its impact on businesses is also generating discussion in the context of non-financial reporting, such as environmental, social, and governance reporting, or ESG. So before we get into the detail of the financial reporting aspects, I wanted to briefly recap some key messages in relation to non-financial reporting. ESG reporting is evolving around the world, and some countries are further along than others in this area. We can almost draw a parallel to the pre-IFRS world, where there was not necessarily one generally accepted framework or way of reporting this information. Various bodies around the world are weighing in on non-financial reporting and considering whether one set of global standards might be appropriate for reporting on ESG type information. In September, the IFRS Foundation trustees published a consultation paper to assess demand for global sustainability standards and noted that if demand is strong, they will assess whether and to what extent the foundation may contribute to the development of such standards. One possible option outlined in the paper is a new sustainability standards board operating alongside the ISB. A number of countries have already mandated some form of ESG reporting, and still more are likely to follow suit in the near future. In turning to the financial statements, the impact of climate change is a high-profile issue that investors and regulators are focusing on. On the one hand, there is the threat of exposure to the physical risk of climate change, such as severe weather events and the effects of rising temperatures. Alongside the physical impacts are what many call the transitional impacts, and by this we mean the policy changes and economic consequences of efforts being made towards decarbonization of the economy. In terms of the latter, this is both a top-down impact in the form of changes to legislation and policy, as well as a bottom-up shift in consumer preferences for low or no carbon emissions products. Stressing the importance of taking global commitments to decarbonization into account in annual reports, the Institutional Investors Group on Climate Change recently sent a letter to the audit committee chairs of 36 of Europe's largest companies, detailing investor expectations for Paris-aligned accounts. The IIGCC have more than 270 members, mainly pension funds and asset managers, across 16 countries with over 35 trillion euros in assets under management. One of the key messages in their letter was the following. Not only is it important that boards ensure consistency between their narrative disclosures on climate risk and their financial statements, that is, it would not be consistent to emphasize climate risk in the strategic report, but not consider the same risks in the accounts, but prudent capital allocation depends on Paris-aligned accounts. So having accounts consistent with the commitments made in the Paris Agreement, which is a legally binding agreement to limit global warming to below 2 degrees Celsius compared to pre-industrial levels. From 2020, signatories have communicated actions that they must commit to take to reduce their emissions in order to reach the goals of the Paris Agreement. And these commitments will inform policy and will impact companies in the affected jurisdictions and industries. This is just one of a number of letters that have been sent emphasizing the need to consider the impact of climate risk in financial reporting. In November of 2020, the ISB published some new educational material, The Effects of Climate-Related Matters on Financial Statements, to help support the consistent application of IFRS requirements to climate-related matters where their effect is material to financial statements. This educational material complements an article that ISB member Nick Anderson wrote on this topic more than a year ago. This webcast will cover the areas discussed in the ISB educational material, as well as a few other important areas to be aware of. We'll share some helpful examples along the way to illustrate the concepts. It is important to highlight that the areas we will cover today do not relate to any new IFRS requirements. Rather, this is a clarification of the application of existing requirements in IFRS as a basis for incorporating climate risk into financial statements. I'll now hand it off to Gary, who will discuss a very common area that companies are focusing on, impairment.
We covered impairment in some detail in our December webcast, and I would encourage you to review that webcast in addition to the content we'll cover today if you'd like to focus on impairment specifically. Now, some ways that climate change could affect an entity's impairment models could include, number one, climate change could be an indicator of impairment and trigger the need for an impairment test. For example, a decline in demand for products that emit greenhouse gases could indicate that a manufacturing plant may be impaired. Or the introduction of new legislation could cause a company to reassess the viability of a product line or result in the imposition of new costs, triggering the need to test the associated assets for impairment. Engaging in activities that are seen as potentially damaging to the environment could result in reputational damage, loss of customers, and could impact the value of brands, trademarks, and other intangibles. Voluntary environmental commitments that the company has made may also need to be taken into account. For example, a commitment to discontinue a product line or decarbonize its operations could be an indicator of impairment. And this is one of the key reasons why the finance team should be aware of the company's plans and their commitments with respect to climate change. The second item is impacts to the cash flows in a VIU model. This could be an adjustment to the forecast of income generated by an asset or changes to an entity's cost base. So for instance, there may be a change in the costs directly related to carbon pricing, the costs of inputs into production, or even overheads, such as rises in insurance premiums in areas exposed to physical climate risks. An entity may need to make judgments about the extent to which it can pass price increases on to its customers. The third point is the impact on the length of the cash flow forecast period and terminal growth assumptions. This may be particularly relevant in looking at assets in energy-intensive industries or for assets based in countries that have signaled decarbonization as a priority. Now, typically, impairment models have tended to assume positive growth rates at the rate of long-term inflation. However, for certain industries, a negative growth rate or a finite forecast period may be necessary. As we mentioned above, promises the company makes in its ESG or integrated reports may need to be reviewed and could result in changes to the cash flow forecasts to the extent there needs to be consistency between the assumptions underlying the financial statements and the plans laid out in the company's sustainability reporting or other public statements. The next item is discount rates. There may be different scenarios where environmental regulations are forecast to be put in place at different times or with different levels of stringency. And therefore, sometimes multiple scenarios may need to be built into the impairment testing to deal with these inherent uncertainties. Now, generally, given the potential uncertainties associated with these scenarios, best practice would be to incorporate these into various scenarios in the cash flows rather than adjusting the discount rate. Entities should remain careful that the same risks are not double counted in both the discount rate and the cash flows. And I think we've mentioned that a couple of times in the past. And last but not least, impairment disclosures. They may need to explain climate-related risks. Where climate-related risks could have a significant impact on a company's operations, information about how this has been factored into the recoverable amount calculations would be relevant for the users of the financial statements. Now, investors are putting more pressure on companies to ditch boilerplate disclosures in favor of specific, tangible analyses of a firm's exposure to climate risks and how this impacts the company. In some cases, the conclusion not to adjust an impairment model for climate risk may be based on significant judgments or assumptions that entities should reflect in their financial statement disclosures. Now, the impacts needn't all be negative. It's not all bad news. Climate change presents both risks and opportunities for entities. I would caution, however, that the value in use method requires an entity to apply strict limits on when the benefits of restructuring, improvements, or investments in an entity's assets that can enhance performance can be taken into account. And these benefits can only be reflected in a VIU calculation once an entity is committed to the restructuring. For enhancements to assets, these benefits can only be taken into account when an entity has started to incur the related expenditure. Entities should also be careful when factoring assumptions about premiums that they can command for carbon neutral products into their forecasts, especially if similar technologies and investments are also available to their competitors. If an entity has used a market-based measure of fair value, determining the fair value less cost of disposal, when doing that, it is important to keep in mind that market participants may already take climate risk into account in determining fair value. To the extent that this is the case, this will already be reflected in the reference points used in the market approach, and so no adjustment would generally be needed. Let's get practical and illustrate these concepts with a few examples. Example 1, let's look at impact of legislation. Now, assume a group operates in an energy-intensive industry, and the ongoing viability of their product is considered to be stable. However, the management team have noted that it is likely that the continued creation of carbon emissions will attract more cost in the future through a carbon tax. As a result of this, the management team have updated their cash flow forecasts used as a basis for the terminal value in their value in use calculation for impairment testing purposes. And what they've done is they've reduced the operating margin by 1% to factor in the incremental cost expected for acquiring additional carbon emission credits. And it's assumed they've done that after taking into account any expectation they may have of some additional costs that can be passed on to customers through higher pricing. Let's have a look at a second example, one that's covering impact on cash flow projections. Now, assume here that a supermarket retail group has made a promise to its customers that in 3 years' time, all of its own branded products will only be sourced from carbon neutral certified farms. And management expects that it'll increase the input cost as a result of doing this by 5%, and that only 3% of that price increase for its products would be viable to pass on to its customers. Now, this could be in part due to similar programs expected to be implemented by the entity's competitors. And in this case, what management will need to do is adjust their gross margin in their forecast models down by 2% in each period that's affected. Let's have a look at example 3, benefits of a potential restructuring. Now, assume here a company in the transport industry develops plans to invest in a low emission fleet in response to new legislation targeting carbon intensive freight. At year end, the company is still assessing the range of options, which would be estimated to reduce its cost base by, let's say, between 15 to 20% compared to maintaining its existing fleet. The company is reviewing its annual goodwill impairment model in the context of the new legislation and the options that are available to it. Now, unfortunately, the company would not be able to take into account the expected benefits of the potential improvements in a VIU model because it hasn't yet implemented those improvements. Now, a fair value less cost to sell model, though, may need to be used if it is reasonable to expect another company, that is another market participant, could also take advantage of the cost reductions by investing in a more carbon efficient fleet. I think, as you can see, there's a lot to think about when it comes to IAS 36 and impairment testing.
The accounting for financial instruments can also be impacted by climate risk. One issue that we've seen with increasing frequency is the accounting for green loans. These are loans where the interest rate is linked to certain environmental, social, and governance metrics. That is, loans where the cash flows under the contract vary depending on an ESG metric or measure. For example, these measures might relate to compliance with emission standards, energy efficiency metrics, or even a combination of different green measures. The interest rate on the loan is adjusted periodically to reflect changes in the borrower's performance relative to those green measures. Green loans have accounting implications from the lender's and from the borrower's perspective. Let's start with the lender's perspective first. Here, the issue is in assessing whether payments on these arrangements are solely payments of principal and interest, commonly referred to as the SPPI test. This is important because it determines whether the loan can be measured at amortized cost, fair value through OCI, or must be carried at fair value through profit and loss. Failing to pass the SPPI test would mean that the loan would have to be measured at fair value through profit and loss. That would be the only classification. So what are some considerations in thinking about whether the loan is SPPI compliant? Well, judgment will be involved, and this is an area that continues to evolve in terms of where the line will be drawn between SPPI and non-SPPI features. In order to determine whether such loans satisfy the SPPI test, the contractual terms that determine variability in cash flows as a result of the green measures should be carefully assessed. One consideration when applying the SPPI test is whether the link to green measures is reflective of changes in credit risk. In making this assessment as to whether or not the variation in interest rate reflects a change in credit risk, it will be important to understand the commercial rationale for including the green variability in the loan and to consider the cause and effect relationship in changes to the interest rate driven by green variability. Let's illustrate these concepts with an example. So let's consider a loan advanced to a power generating business that operates a single power plant. The loan is secured against the power plant asset. The interest rate on the loan increases if CO2 emissions from the power plant exceed a predefined threshold. This is because regulation would require the quantity of power produced by the plant to be reduced if CO2 levels exceed the imposed statutory limits, and in more extreme situations, the plant could be required to shut down due to statutory emissions regulations. As a result, exceeding the CO2 emissions in the loan will increase the risk that the borrower's income from the plant would be lower and increase the probability of default, that is, the likelihood that the borrower cannot repay the loan. It will also likely reduce the value of the power plant and therefore increase the loss given default of the loan. Because exceeding the predefined CO2 emission threshold reflects an increase in the credit risk of the loan, the lender may be able to demonstrate correlation of the green variability to the credit risk, such that it will qualify as SPPI, subject to considering all other relevant factors. Because this is a rapidly evolving area, entities should be sure to keep up to date on the latest discussions and practice in this area. Green loans can also raise considerations from the borrower's side, as they create a need to consider whether the green variability features in the loan give rise to an embedded derivative, and if so, whether that embedded derivative should be accounted for separately from the loan. For green variability to meet the definition of a derivative, among other criteria, the value of the green variability feature must fluctuate in response to either a financial variable or a non-financial variable that is not specific to a party to the contract. In determining whether this criterion is met, the type of sustainability linked feature is important. If the sustainability linked measure is based on a factor specific to either the borrower, the issuing entity, or to the lender, the holder, no embedded derivative would exist as the green variability as a separate standalone instrument would not meet the definition of a derivative. We'd expect that this would often be the case for green measures such as the borrower's specific CO2 emissions over a defined period, or the borrower's compliance with emissions and waste regulation standards, or, for example, with energy consumption standards. However, where the sustainability linked measure is a variable that is not specific to the borrower or the lender, given it will be settled at a future date, the feature could meet the definition of a derivative. For example, green measures such as indexation to the trading prices of carbon emissions credits are unlikely to be specific to either the borrower or the lender. Where the sustainability linked feature meets the definition of a derivative, you would need to consider whether it is closely related. Where the measure is not specific to the borrower or to the lender, the economic characteristics and risks of the sustainability linked feature would often not be closely related to the economic characteristics and risks of the host contract. In this case, the sustainability linked feature would be separately accounted for if all other conditions are met. If it is determined, on the other hand, that the sustainability linked feature is not separated as an embedded derivative, that is because it's closely related or doesn't meet the definition of a derivative, the next question is to consider how to account for this from the borrower's perspective, where the loan is carried at amortized cost. Where the changes in expected cash flows reflect movements in market rate of interest, then paragraph B545 of IFRS 9 should be applied. This would generally be expected when the green variability reflects credit risk and when the interest rate movements from the sustainability linked measure is commensurate with the change in credit risk. Applying paragraph B545 of IFRS 9 would often have no significant effect on the carrying amount of the liability and result in changes in the market rate of interest being reflected in the period in which the change occurs. Where these changes in expected cash flows do not reflect movements in market rates of interest, paragraph B546 of IFRS 9 should be applied. That is, the gross carrying amount should be adjusted. The gross carrying amount is recalculated as the present value of the estimated future contractual cash flows and discounted at the original effective interest rate. And any adjustment would be immediately recognized in income in profit and loss. In our experience, the terms of green loans can vary widely, and a lot of judgment can be involved in assessing the accounting for these instruments under the requirements of IFRS 9. And as mentioned, practice continues to evolve in this area, so please do keep yourself informed about any changes that are happening in these assessments. Climate change may also affect a lender's exposure to expected credit losses, or ECL, for its financial assets. IFRS 9's ECL model requires that reasonable and supportable information that is available without undue cost or effort be taken into account in the calculation of ECL. Climate change may affect the assumptions that are made by lenders to estimate those ECLs. It could also affect the risk ratings for individual borrowers or groups of borrowers, or their probabilities of default. And in some cases, it could also result in moving loans between stages within the IFRS 9 ECL model. Borrowers could face a range of physical, regulatory, and reputational risks that ultimately impact their credit risk and increase the likelihood that they may be unable to meet their debt obligations. Moreover, the value of assets against which the loans are secured could fall in value or even become inaccessible or uninsurable, affecting the fair value of that collateral. So a few things to think about in particular when considering the impacts on ECL. Firstly, think separately about physical risk and transition risk. So physical risk is, for example, the destruction or temporary disruption of physical assets from the increased risk of severe weather events. And transition risk relates to, say, the advancement or displacement as a result of moving to a greener and more sustainable economy. So important to think about both of those types of risk. Be mindful of duration. While change is happening fast, longer term exposures are likely to be more impacted than shorter term exposures. And also it's important to note that one size doesn't fit all in this context. So different portfolios will have different risk exposures depending on duration, industry, geography, etc. And in many cases, only top-down assessments of vulnerable geographies and industries will be possible. It's also important to avoid double counting of risks. So consider the extent to which they may already be incorporated directly or indirectly through model inputs like market credit spreads, expected default frequency, and other factors. And also consider other arrangements like insurance, guarantees, government subsidies, and other sources of recoveries, including how they've been structured and how their providers are thinking about and responding to evolving ESG risks. And these ECL considerations are not only important to banks, but also to corporate lenders, particularly those with exposures to industries most significantly impacted. The final consideration we'll cover in relation to financial instruments is financial instrument disclosures. Amongst other things, IFRS 7 requires disclosure of information about the nature and extent of risks and how the company is managing those risks. Entities may have to change the way they are approaching their risk concentration disclosures to take into account climate risk. So for example, more precision in geographic concentration may be necessary to reflect heightened risk in particular areas. For example, city versus provincial or state disclosures where a particular city is particularly impacted. Or more precision in the industry sector as well. So for example, more precise disaggregation of exposure to the industrial products sector based on carbon intensity. Companies will also need to consider disclosures about market risk, for example, for investments in industries impacted by climate risk. In some cases, sensitivity of investments to carbon credit pricing may also be relevant. Finally, liquidity risk may also be a consideration. So as an entity's climate risk exposures become more significant, there may be growing pressure on an entity's debt covenants. In this context, disclosures about key covenants may become increasingly material, and reduced access to funding from investors in carbon-intensive industries could also be a risk that entities need to address and disclose.
The recoverability of other assets, such as inventories and deferred tax assets, could also be affected by climate risk. So in addition to impairment, which we just discussed, the useful lives and residual values of plants and equipment and intangible assets may need to be reassessed as a result of climate change. For example, climate impacts could result in earlier obsolescence of assets, legal restrictions may be placed on their use, or lead to inaccessibility of the assets. And sometimes in the most extreme cases, if assets become inaccessible either as a result of a natural climate event or government action, an entity could even lose control of the assets permanently. IAS 16, our standard on property, plant and equipment, requires the useful life of assets to be based on an entity's best estimate. And this estimation of the useful life of assets is a matter of judgment. And where this judgment has a significant risk of resulting in a material adjustment to the carrying amount of assets and liabilities within the next financial year, this would generally need to be disclosed. The next item is inventories, and these may become impaired if the cost of inventory is not recoverable. And IAS 2 requires a company to write down such inventories to their net realizable value. For example, certain sectors may experience increased volatility in market prices of their assets, for example, as a result of changes in demand patterns for certain commodities, which could expose those inventories to greater risk of impairment. And this is probably more relevant to entities that have a longer operating cycle. And in other cases, certain assets may be discontinued from use or production, which may result in impairment of the parts of those assets. For example, a certain model of combustion engine may be discontinued because it no longer meets emission standards, making the parts used to produce the service or service that engine obsolete as well. So it could be a knock-on impact. And finally, the recoverability of deferred tax assets may also come into question for similar reasons as we discussed when considering impairments of other non-financial assets. Folks may recall deferred tax assets are often recognized only to the extent that it's probable an entity will generate future taxable profits, and climate change might impact the company's estimates of future taxable profits and result in it not being able to recognize deferred tax assets, or lead it to de-recognizing those previously recognized deferred tax assets. If the entity performs an impairment test, what's important is the assumptions between the assessment of recoverability of deferred tax assets and the impairment test of non-financial assets should be aligned. On the liability side of the balance sheet, climate risk can have an impact on the recognition, measurement, and disclosure of provisions and levies. This could impact restructuring provisions and environmental or decommissioning obligations. Actions taken or statements made by the entity could give rise to constructive obligations for which provisions should be recognized, even in the absence of legislation requiring the entity to take action in some cases. And again, in other cases, higher production and other input costs could result in changes to the recognition and measurement of onerous contracts. For obligations arising from new legislation, it's important to remember the requirement that a provision would be recognized only when there is the legislation that is substantively enacted. In many cases, this will not occur until a law is actually passed and becomes legislation within that territory. Now let's illustrate some of the complexities with a few examples, starting with a decommissioning provision. Assume a company operates a plant that is heavily dependent on fossil fuels and for which it has recognized a decommissioning provision. The sustainability strategy of the entity promises carbon neutrality by 2030, and this can be realistically only achieved by substituting the plant with a newer hybrid model plant in the midterm, sooner than originally anticipated. It may be possible to substitute and decommission the plant somewhat earlier than 2030, but it would require the purchase of carbon offsetting credits in the meantime. And as a result of this plan, the company must bring forward the timing of the expected cash flows for decommissioning the plant, due to an earlier decommissioning of the plant than originally envisaged when the provision was first recognized. In this case, the company brought forward its decommissioning voluntarily. The public statements it made in its sustainability strategy triggered a reassessment of when the decommissioning would need to take place. Of course, this could also be necessary to consider adjusting the timing for when decommissioning obligations will be settled as a result of new legislation. And in these cases, the provision would likely be adjusted when the legislation was substantively enacted to mandate the earlier decommissioning. In the next example, a company has made a public statement that it is committed to reduce its emissions to net zero by 2030. The company has published a detailed plan outlining its strategy to discontinue operating a carbon-intensive manufacturing facility, to invest in renewable technologies at its other sites, and purchase carbon offsets in order to meet this target. Now, assume the company commits to spend 10 million currency units over the next 5 years to ensure this target is achieved. There is no legal obligation for the company to reduce its emissions. The company is assessing whether these statements create a constructive obligation for the business. Now remember, folks may recall, a constructive obligation arises from a company's actions where, by an established pattern of past practice, published policies, or sufficiently specific current statements, the entity has indicated to other parties that it will accept certain responsibilities, and as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. In this case, due to the specificity of the statements made and the fact that the company has previously met similar environmental commitments in the past, one can assume there is a valid expectation that the company will invest in accordance with the plan and purchase the required offsets to meet its targets. However, IAS 37 also explains that it is only those obligations arising from past events existing independently of an entity's future actions, that is, the future conduct of its business, that are recognized as a provision. So there's normally quite a lot of judgment to be applied here. And I guess in this case, some but not all of the company's statements may create an obligation independent of the company's future operations or actions. For example, the obligation to purchase carbon offsets from 2030 could be reduced if the company takes action to reduce its emissions by 2030. Therefore, a provision for the purchase of the offsets would not be recognized before 2030 because the obligation is not independent of the company's future actions. The commitment to invest in specific renewable technologies is also unlikely to result in a provision, as it will likely relate to commitments to purchase assets in the future. However, a detailed plan to shut down an existing manufacturing facility may create a valid expectation that the company will incur certain unavoidable costs to restore the site of the facility, terminate contracts, and so on. Therefore, the amount of the provision recorded may not reflect the full 10 million amount that the company has committed to spend over the next 5 years. So again, a relatively simple example, and I think in the real world, a lot of judgment will need to be applied, but hopefully this illustrates the concept. In the next example, we'll illustrate how the measurement of onerous contracts could need to be adjusted to take into account additional environmental costs. A company has an existing onerous contract provision in relation to a long-term supply contract with a customer. Assume the provision for the contract is calculated based on the probability of weighted outcomes. When reviewing the different scenarios that are probability weighted, the company considers that there are increased costs in a particular climate change scenario on production and delivery of these products. For example, higher air freight costs, as well as higher production costs due to carbon offsetting credits that need to be acquired. Now, it'll need to factor this increase in costs into these scenarios, and as a result, the probability weighted expected revision would increase due to the change in inputs for that scenario.
Fair value measurements can be impacted wherever fair value is used because a market participant's view may include assumptions about climate-related risk. As we mentioned in the context of impairment, fair value measurements using observable inputs may already be appropriately reflecting market participant views of climate change inputs. For example, for quoted equity prices of an entity in the extractives or agriculture industry, those level 1 quoted prices will already reflect market participants' views about climate risk. However, prices in illiquid or thinly traded markets should be reviewed, as these may need to be adjusted if they do not adequately reflect the risks of climate change. Other valuations, particularly those involving forecast, may need to be adjusted to factor in climate risk. For example, the fair value measurement for an investment property may need to be adjusted to reflect climate impacts on rental income, occupancy rates, or even insurance cost assumptions. Climate-related risks may also impact business combination fair value exercises relating to all assets and liability categories, from provisions to customer relationships or inventories or brands or trademarks, and risks relating to investments in entities that are located in high climate risk geographies or industries should also be reviewed. Finally, the fair value of biological assets, such as trees being grown for timber or fruit before the point of harvest, may need to factor in changes on the income and the cost side. For example, changes in consumer dietary preferences and shifts to low carbon products may impact the price of produce. On the cost side, changes in expected cost as a result of physical risks such as storms and changes in the cost of inputs such as water and regulatory tariffs like those related to land use may be relevant. IFRS 13 requires disclosure of the inputs used in fair value measurements, and for recurring fair value measurements, a description of the sensitivity of those measurements to changes in unobservable inputs. So remember to make sure that the disclosures are adequately reflecting climate risk as well. Emissions trading schemes vary around the world. The world's largest scheme is in the European Union, but other schemes exist in various countries around the world and sometimes even vary between states or provinces in a country, for example, in the United States and Canada. Most of these schemes cover carbon dioxide emissions, but some also aim to cover other types of emissions. And their fundamental purpose is to encourage reductions in such emissions through incentivizing companies that engage in carbon neutral or carbon negative activities and stimulating investments in those businesses. Some businesses may be more carbon intensive, but the aim is to effectively offset such emissions by reducing emissions to the extent possible in other businesses or promoting activities that otherwise offset emissions. The schemes generally involve the allocation of a limited number of allowances at the start of a defined compliance period and require the entities to have sufficient allowances at the end of the compliance period to cover the volumes of emissions that they emit. Some schemes permit entities to purchase additional allowances on top of their free allocation or to sell any surplus allowances generated from reducing their emissions. There are usually penalties imposed for exceeding the allowances or failing to surrender enough allowances to cover all of a company's emissions. The schemes have been around for some time, however, they're again becoming a hot topic for a few reasons. Firstly, the price of carbon credits has generally been increasing around the world. This means that such programs are becoming more material to companies' results, both for those that need to purchase credits to meet compliance obligations and for those that are generating credits to sell as part of their business activities. The world's carbon markets grew by 20% in 2020, reaching a total valuation of about 229 billion euros, according to the annual Refinitiv Carbon Market Review, and the price of credits has consistently broken records over the past 12 months. This is partly the effect of targets becoming more stringent over time. More businesses are getting involved in generating carbon credits. Some have sought to diversify their energy mix. Many conventional energy companies have expanded into wind or solar energy or investing in carbon capture technologies. The impact of carbon emissions trading is becoming increasingly critical in the economics of various businesses and investment decisions. Of course, many entities are more focused on reporting on carbon emissions as part of their ESG disclosures and are working towards their own carbon targets. In some cases, the carbon credits generated by such decisions can help defray the cost of these initiatives. However, in turning to the accounting, we note that there is actually no specific accounting standard that deals with the accounting for emissions trading schemes. IFRIC 3 was intended to address the accounting in this area, but was withdrawn in 2005. There are some complex conceptual accounting questions about the nature of obligations arising from pollutant pricing mechanisms, particularly where the entity receives emission allowances from the scheme administrator for no monetary consideration. There are also questions about whether, and if so, how to recognize assets and liabilities arising from pollutant pricing mechanisms. The withdrawal of IFRIC 3 means there are a number of accounting models that can be used under IAS 8 for accounting for participation in these schemes, and there continues to be significant diversity in practice in this area. One model is the IFRIC 3 model, which dealt with the accounting for a cap and trade emissions rights scheme. Although the interpretation was withdrawn in 2005, it remains a valid interpretation of existing IFRS. I will call the IFRIC 3 approach a full market value approach, and will illustrate this model's application alongside two other models that are acceptable: the cost of settlement approach based on the initial market value, and the cost of settlement approach based on the nominal amount. So let's start with the asset side. Under all three approaches, the initial allocations are treated as a government grant of an intangible asset. However, under the nominal approach, the asset and the government grant income are both measured at a nominal amount, usually nil. Under the full market value and initial market value approach, the asset and the government grant are measured initially at market value at the date of initial recognition. They might subsequently be remeasured to fair value if a fair value model is selected for these assets and there is an active market for them. The government grant income is then amortized over the compliance period on a systematic and rational basis. The intangible assets are not amortized but should be tested for impairment. On the liability side, the measurement for the emissions obligations will differ depending on the model selected. Under each model, the liability is initially recognized when the obligation arises, that is, when the liability is incurred. Under the full market value approach, the liability is measured based on the market value of allowances at the end of each period. That is, in this approach, irrespective of whether they are to be settled using the allowance on hand or purchased from the market. Under the initial market value approach, the liability is also remeasured at each period end. However, the liability to be settled using allowances on hand is measured at the carrying amount of those allowances. Any liability to be settled in excess of allowances on hand is measured at the market value of the allowances at the end of the period. Similarly, under the nominal amount approach, the liability is remeasured at each period end. The liability to be settled using allowances on hand is measured at the carrying amount of those allowances, which is usually nil. Any excess emissions are measured at the market value of allowances at the period end. In some cases, an entity may enter into a forward contract to buy allowances at a fixed price on a future date. In this case, it is permissible to recognize a provision with reference to the forward contracted rate rather than the prevailing market rate, because this is the best estimate of the amount that the entity expects to settle its obligation at. Last but not least, climate change may impact the assumptions used to measure insurance liabilities. For example, climate-related events may increase the frequency or magnitude of insured events or accelerate the timing of their occurrence. This could include, for example, the result of increased frequency and severity of extreme weather events, such as floods and fires leading to business interruption, property damage or injury, or the chronic effects of rising average temperatures resulting in increased incidence of illness or higher mortality rates. Therefore, the impacts could be seen by both life and non-life insurers. An entity may need to disclose significant judgments and changes to those judgments as a result of assumptions about climate risk. Companies may also need to reflect climate risk in disclosures about risk exposures, concentrations of risks, how it manages those risks, and sensitivity analysis showing the effects of changes in risk variables.
Climate change can introduce significant uncertainty about the future. Assumptions an entity makes about future scenarios and the likelihood of those scenarios playing out can have a material impact on what an entity reports. Now, we've touched on a number of areas where additional disclosures may need to be provided to explain how climate change has been taken into account within the financial statements, including specific requirements relating to assumptions and risks. But folks may recall there's an overarching requirement to disclose sources of estimation uncertainty in IS1. If assumptions a company makes about the future have a significant risk of resulting in a material adjustment to the carrying amounts of assets or liabilities within the next financial year, IS1 requires disclosure of information about those assumptions and the nature and carrying amount of those assets and liabilities. Entities are also required to disclose the sensitivities of carrying amounts to the assumptions and estimates. So, for example, if climate change matters create uncertainties that affect assumptions used to develop estimates, those assumptions might need to be disclosed if those assumptions have a significant risk of resulting in a material adjustment to the carrying amounts of assets and liabilities, and the impact of various potential climate scenarios on the financial report may need to be explained as well. And finally, entities would typically explain changes made to past assumptions if they're material. Critically, the assumptions that underpin the entity's financial reporting should align to the assumptions and analysis described elsewhere, such as the company's climate or sustainability report or their other integrated reporting related disclosures, often referred to as ESG. Now, IS1 also has a general disclosure requirement to ensure the accounts capture all information that would be considered material. IS1 requires entities to provide information that is not presented elsewhere in the financial statements, but it is relevant to an understanding of them. Now, these overarching requirements in IS1 may be especially relevant for companies whose financial position or financial performance is particularly affected by climate-related matters. So, how can companies tackle all of this? Well, as we shared in December, the first step is understanding the impacts for a particular organization. Obviously, some industries that are carbon intensive could be more impacted than those that are in lower carbon intensive industries. In many cases, companies have sustainability or environmental functions which are developing the company's plans in response to climate change. And it's important that those involved in financial reporting stay in close contact with those individuals and make sure that the consistency with estimates and assumptions used in financial reporting is well thought through and documented. Now, this is an emerging area, and companies' controls over gathering such information may not be as developed or robust as controls in other areas. Companies should be considering whether new or revised internal control processes may be required. And a good exercise for companies to consider might be mapping out all of the key estimates that are required that an entity is required to make in their financial reporting, and the level of influence that climate change might have on those assumptions. In addition, as we just mentioned, discussing climate-related risks and opportunities with others in the organization who are focused in this area might also provide insight as to the areas of the financial statements that might be affected. This would have an added benefit of ensuring that those working outside of the financial reporting function know the impact of their actions or decisions or statements and what those might have on the financial statements. We talked about the fact that climate risk can impact the financial statements under IFRS and the many estimates that can be impacted by such risks. And it's also really important to take a step back and think about the impact of any non-financial ESG information that has been disclosed, and think about the overall consistency of the messaging between the financial reporting, management commentary, and the environmental, sustainability, and governance information. Is the company telling its story to stakeholders in a clear, consistent, and understandable way throughout these documents? Hope so. Not operating in silos and ensuring that the financial reporting and ESG functions are talking to each other is usually key in providing quality information. So I guess the key message here is collaboration. We hope you'll find this webcast helpful as we navigate some key issues arising from climate risk, which can be quite tricky. I know we've covered a lot of ground today, and so I also wanted to highlight where to go for some additional resources. In particular, I want to share some of the materials that are available on Viewpoint. Now, Viewpoint is our relatively new digital platform for accounting and business insights, and it replaces PwC Inform. If you've had a chance to explore the new platform, you'll know that amongst other things, Viewpoint offers intuitive search functionality, a personalized homepage, as well as topic and industry landing pages. Now, these pages are curated on a regular basis by our PwC subject matter experts, and that includes climate change. So it's probably a great place to start and come back to as you work through the impacts climate change has on your corporate reporting. Thanks very much for listening to us today. I look forward to seeing you again with my fellow partners soon. Please refer to the links below for more information. Cheers.